This is the content of lesson 1. Definition, need for partnership firm, essential features of partnership, types of partner, partnership deed, clauses generally in partnership deed, rules applicable in the absence of partnership deed. Let's see the meaning of partnership. A partnership is one of the forms of business. It is a formal agreement between two or more people, share ownership, capital as well as the responsibility for managing business and the net results of the same. History reveals that the partnership organization was started with the enactment of Partnership Act in 1907 in England. In India, the act was approved in 1937. From this, we can understand that it is a formal agreement. A partnership business is arising out of a formal agreement between people, two or more people, and they share ownership, capital, as well as the net result of the business. It may be either profit or loss. Definition. According to Section 4 of the Indian Partnership Act 1932, partnership is defined as the relationship between persons who have agreed to share the profits of the business carried on by all or any of them acting for all. Persons making an agreement to carry business for common purpose are called partners individually and firm collectively. The name under which the trade carried is called the name of the firm. In this slide, we can see the need for partnership firm. There are several forms of business organization: sole proprietorship, joint Hindu family firm, company and all. Partnership firm is also a very successful and popular one. Why people prefer partnership firm? Because a person who runs a business, who is new to the business, he requires he prefers only the partnership firm, because the business world is very hectic and a competitive one. In order to face the competition confidently, in order to run the business successfully, earn profit, multiply the profit, he needs a partnership firm. He needs varied skills or experience. Huge amount of capital is required to expand the business or to diversify the business. So partnership firm is preferred. This slide clearly shows the reasons for the preference of the partnership firm. First one, more capital. Sole proprietorship. In the case of sole proprietorship, he cannot collect, he cannot mobilize more capital. Okay, for the medium scale business, partnership firm is apt. More effective supervision and control. One single individual is not well versed in all the fields of business. He may be well versed in finance, he may be weak in human resource management, and so in that case he needs a partnership firm. Two heads are better than one. No. So in that concept, many people prefer partnership firm. Then greater specialization is possible because of the division of work. They divide the work and they do the work repeatedly, and so they get specialization. Specialization increases the profit and reduces the cost. Dilution of risk. Here also the risk of the partner is unlimited, but it is joint and several. And so it is the extension of partnership firm, is the extension of the sole proprietorship. It is arising out of the weaknesses of the sole proprietorship firm. Under the sole proprietorship, a single individual has to carry or has to shoulder all the risk. Work burden is heavy. Here it is diluted, and so many people prefer partnership firm. Then, essential features of partnership. First one, contractual relationship. There must be an agreement between two or more persons. That agreement governed by the Indian Partnership Act 1932. Social gathering is not considered as a partnership firm because agreement is a must. Only person who are capable legally of making an agreement can become the partners. A lunatic, insolvent cannot become a partner because they are not eligible to enter into an agreement according to law. Then they are not competent enough to enter into a contract. Existence of business, they must do the business. Business means any trade or occupation or profession. Even partnership of lawyers, general stores or chartered accountants are accepted as partnership. In case if they do some religious or charitable work, such association is not considered as a partnership firm. Then the third important features of the partnership firm is lawful business. The business which is carried out by the partners in the partnership firm must be a legal one. They should not indulge in illegal activities, or if they do any illegal business, the court will interfere and they have to face the legal consequences. They will not run the business. After that, they will not be allowed to run the business. Fourth one, agency relationship. The business must be carried on by all or any of the persons concerned acting for all. There must be an agent and principal relationship between the partners. Fifth point is number of members. Partnership is the relationship between two or more persons. Minimum number of persons required to start a partnership firm is 2. A single individual cannot start a partnership firm. Minimum is 2, maximum is 10 in the case of banking business and 20 in the case of other business. As far as liability is concerned, in the partnership firm, partners' liability is unlimited. In case the partnership faces losses, the private assets of the partners can also be used. Sharing of profit. The profit or loss of the partnership is shared between the partners in the ratio as given in the agreement. If the agreement is not mentioning it, they have to share the profit or losses equally. So, agreement is essential. Written agreement is highly desirable. It is not mandatory to have written agreement, but it is highly desirable to have an written agreement in order to avoid future clashes between the partners. If the agreement is silent, in that case, they have to share the profit or losses equally. Team spirit, mutual trust and motivations is a must between the partners in order to have a long survival of partnership. If they have clashes, if they don't have team spirit, if they don't have mutual trust and motivations, the firm will be collapsed. So if they want to run the business in a long years, they must have all these qualities. And transfer of share. No transfer is allowed without the permission of all the other partners. As he wishes, he cannot transfer his shares in business. A partnership legal status. A partnership firm has no separate legal entity, but a company has a separate legal entity. The firm and the partners are one and the same. It is terminable by death or insolvency of the partners. The partnership comes to an end if a partner dies or insolvent. Registration. It is not compulsory to register a partnership firm as the firm does not a separate legal entity. However, having a registration will make it definite that the firm exists legally. It is not mandatory to register a firm. It is not compulsory, but if they register, that will make the firm a legal face. Then the types of partner. First partner is called active partner. Active partner is one who takes active part in the day-to-day working of the business. He spends more time and may possess special skills and knowledge in the business of the partnership firm and uses the same to manage the business successfully. In a nutshell, he acts as an agent of all the other partners in order to carry out major functions pertaining to business. He may play a different role such as manager, organizer, advisor and controller of all the affairs of the firm. The other name of active partner is working partner. He can withdraw remuneration from the firm in case that the same is allowed by the partnership deed. If the partnership deed is allowing the remuneration to the active partner, he can very well withdraw the remuneration because he plays an integral role in partnership firm. If he wants to retire, he has to give public notice. Unless otherwise, if he doesn't give the public notice, he will be held liable for the deeds of all the other partners, even though he is retired. Then second type is sleeping partner. A sleeping partner or dormant partner is one who contributes capital, shares profit and contributes to the losses of the business but doesn't make active part in the working of the concern. He is facing the losses, he is accepting the losses, he is accepting the profit, he contributes the capital but he doesn't take any active part in the business. So he is not doing playing any major role and it is not mandatory for him to give public notice if he wants to retire. As he is not involving any activities of the business, he is not allowed for remuneration. Supposing that the partnership deed is providing remuneration to sleeping partner, it is not deductible under the Income Tax Act 1961. Then the next type of partner is nominal partner. Nominal partner is one who just lends his name to the firm and he doesn't have any real interest in the firm and doesn't have any voice in the management of the firm. He neither contribute any capital nor shares profits of the firm. He is known as partner to the third parties. So he is just lending his name. The partnership firm uses the name of the partner, this particular partner. He may have good reputation or goodwill. So the firm uses his name and he is allowed as a nominal partner. He doesn't have any interest over the business. In order to get more credit in the market and may promote its sales, the firm uses the nominal partner. Actually, the firm uses the nominal partner's reputation and goodwill. However, it is pertinent to note that a nominal partner is liable to those third parties and outsiders who give credit to the firm on the assumption of that person, that is a nominal partner, being a partner in the firm. But he is liable for his act. And if any outsiders lends credit to the firm on the assumption that this nominal partner being a partner in the firm, then in that case, the nominal partner is liable for that one. A person may become a partner for sharing the profit only is called partner in profit only. He won't be liable for any losses of the firm. Moreover, even if he deals with any of the third party, then he will be liable for the acts of the profit only and not any of the liability. He is not allowed to take part in the management of the business. Such partners are associated for their money and goodwill. They are not liable for any loss, but they can get a share in the profits. They are called partners in profit only. Partners by estoppel or holding out. When a person is not a partner but possesses himself as a partner either by words or in writing or by his act, he is called partner by estoppel or holding out. A partner by estoppel or by holding out shall be liable to outsiders who deals with the firm on the presumption of that person being a partner in the business, even though he is not a partner and does not contribute anything to the business. So he is not a partner, but by his words or by his written, if he acts like a partner, he is considered as a partners by estoppel. Next one is sub-partner. A partner may associate anybody else in his share of the firm. He gives a part of his share to the stranger. It is important to note that the relationship is not between the sub-partner and the firm, but between him and the partner. The sub-partner is a non-entity of the partnership firm and he does not hold any rights in the firm. He is not liable for the debts of the firm. There is no relationship between the sub-partner and the firm. There is a relationship that is existing between the sub-partner and the partner who gives a share, who gives his own share, a part of his own share to the partner. That partner is called a sub-partner. He doesn't have any entity in the partnership firm. Then let's view the partnership deed. A partnership deed is an agreement between the partners in which rights, duties, profit shares and other important obligations of each partner is mentioned. In partnership deed, the rights of the partner, liabilities of the partner, obligations of the partner, profit sharing ratio, all those things are mentioned. Partnership agreement can be oral or written. It is not mandatory for a partnership to have written agreement, but it is highly desirable and it helps to solve conflict which may arise between partners in future. A written partnership agreement is a legal document which sets out the rules of the partnership. It is not necessary for the partnership to have a written document, but it is desirable in order to avoid future clashes between the partners. We cannot see two partnership deed or similar. Okay, similar partnership deeds we cannot see, but every partnership deed should contain the following classes. What are they? Name of the firm and nature of business, names and addresses of the partners, duration if any of the partnership firm, total capital of the firm and share of each partner, then ratio of sharing profit and losses, whether capital are to be fixed or fluctuating, whether any interest is to be allowed on partners' capital and if so what rate of interest on advances, whether any interest is to be charged on drawings and if so what rate, amount of salaries or allowances, amount which each partner can withdraw for his private expenses, the provision relating to keeping of proper books of account, the period after which the final accounts are to be prepared, the audit of the accounts, admission of new partner and expulsion of the existing one, the method of ascertaining the share of goodwill of the partner on his retirement of death, whether the decision in case of Garner versus Murray is to apply in the case of insolvency of a partner. Rules applicable in the absence of partnership deed. If the partnership deed is silent or is not mentioning how the partners are dealing with the particular case. Let's see one by one. Profit sharing ratio. If the profit sharing ratio is not mentioned in the partnership deed, then the profit or losses of the partners should be shared equally. Interest on loan. A partner is entitled to interest on loan at 6% per annum because he or she lends money to the firm. Even though the partnership deed is silent, the partners are entitled to get the interest at 6%. Then interest on capital. No interest is allowed on capital. If interest is allowed in the deed, it will be paid only when there is profit. In case of loss, no interest can be allowed. So interest on capital. If the partnership deed is silent, then there is no need for the firm to give interest to the partners which is invested by them. Then salary to the partners. Partners are not entitled for any salary or other remuneration. Interest on drawing. No interest is charged on drawings. But partners may change any of the above by agreement. If they want, they can make any changes in the above cases by way of agreement.